Well, good morning, everyone. Welcome to the Morningstar Conference. We're happy to have you here. This is the beginning of our pre-conference sessions, and I just wanted to kind of go over what we're doing with the pre-conference sessions today. We have 3 tracks. This is the Getting More from Morningstar Manager Research first session. We also have 2 other tracks going on next door in the room one down, Women in Investing and Technology and the Advisor. There's 3 sessions per track. So from 10 to 11, we'll have session 1 in each of the 3 tracks, session 2, 11 to 12. Then there's a lunch from 12 to 1. It'll be right down the hall to our right. And then we'll come back for session 3. So, you can switch tracks if you'd like. In this track, Getting More from Morningstar Manager Research, we're going to spend our time in this way. We've got session 1 right now, Understanding Morningstar Ratings. In our second hour, we're going to talk in a little more depth about how we evaluate funds using our 5 pillars framework. And then in session 3, after lunch, we're going to come back and talk about some of the broader level research that we're doing on the manager research team. So that's our 3 tracks for today. So we're glad that you're here. This ends at, let's see, 10 to 11, 11 to 12, at 2, and then the main conference starts at 3. So we'll have a session, a big general session today from 3 to about 5, and then start tomorrow with main stage sessions and breakouts, and have a really full day tomorrow as well. A couple of things I wanted to do to get started. Just introduce myself. My name's Jon Hale. I'm the Director of Manager Research for North America for Morningstar. I've first started at Morningstar in 1995, so 20 years ago, and started out as a fund analyst. Spent most of my time in the intervening years in our investment management side of Morningstar, where actually I was involved a lot in our sort of institutional level manager research. One of the things we've done just in the past several years is we've tried to start sort of consolidating our expertise, so to speak, in manager research all in one place, rather than having a kind of fund research team on the one hand and an institutional level manager research team in our investment management division. So I've come down to the manager research team, and I say come down because it's actually a floor below where we had our investment management team in our building, and have been at the manager research job here for about a year. And we've done quite a few things to kind of change or evolve what we do over the past several years that I want to give you a sense of as we start today. And it's kind of an entry or an intro to a discussion about the Morningstar ratings. We're going to talk about the star ratings. The star rating is something that's kind of a ubiquitous thing in the industry, and I think a lot of people probably have maybe gone a long time since they've maybe heard exactly how the star rating works. So hopefully for most people it'll be kind of a refresher, but I think it's kind of important to remind folks about what the star rating is and isn't, and from there we're going to talk a little bit about our newer Morningstar Analyst Ratings, and before finishing up by talking about how we evaluate asset management firms and how we rate those. And that'll kind of lead us into the second session. We're going to have a number of our analysts up on stage in the 10 to 11 or the 11 to 12 o'clock hour session 2 to talk in more detail about how we evaluate funds. So just a couple of things to note about our team. We have 3 regional teams, over 100 analysts globally. It's really now become a global effort. I have counterparts in London and in Sydney. It's a very experienced team overall. Here in the U.S., we've got a lot of folks with a lot of experience. I mentioned starting in 1995. We just celebrated 5 analysts yesterday, their 20th anniversary as fund analysts and manager research analysts at Morningstar. And if you're familiar at all with the industry, that's a pretty long tenure. So we have a lot of long tenured folks in our team, a lot of experience covering funds and strategies. About a third have CFAs, another 5 or 6 are in the CFA program, and more than half have advanced degrees. So it's an experienced and very capable team that we have here in North America. And then globally as well, we've got the 3 regional teams. We're really aiming now for having very consistent coverage across the globe, meaning we have the same analytical framework, the same ratings framework in all 3 regions. We coordinate our coverage of strategies that are similarly offered in different regions, so we're not saying one thing in one region and something else in another. So that's a little bit about our global reach. Also, we're now organized here in the US, and eventually we will be globally, by asset class teams. So we've sort of broken down the teams more formally into an equity team, a fixed income team, a multi-asset class team, and an alternatives team. We feel like this allows us to develop a deeper asset class focused expertise and to improve the research that we do overall, and allows for greater focus and collaboration and coordination. You'll see that in the way that we do our ratings of funds. And then finally, we've moved really from calling ourselves the fund research team to Morningstar Manager Research, and it's a sort of, the name reflects a more institutional focus that we've taken on over the past several years. We have now far more detailed, in-depth analyses of all the funds under coverage that's encompassed in our global fund report, and you're going to hear a lot more about that. And hopefully, if you're not already well familiar with the global fund report, you'll want to go take a look at and perhaps use those more extensively in your own due diligence efforts. For years, we really, the only thing we did on the fund analysis side was a very brief little synopsis of a fund's strategy with a very quick kind of assessment thrown in, not anything that could really substitute for a more detailed due diligence report. And what we realized was that, geez, we have all this expertise at Morningstar in the fund research team that's really not being surfaced in the actual work. So today, when we write about a fund, it's in it's a 7-page report. It's very thorough. Yet, I think in the way we designed it, it's also very accessible, easy to digest. It's something that you can, I think, really get your arms around and understand what we're saying in a concise way, but also it's in depth enough that you feel like, yeah, I've really got something here that I can hang my hat on. So that's the Global Fund Report, and sort of following on with the Global Fund Reports, we have actual analyst ratings of all of our funds that are under coverage now. So before we didn't do that. We had the star rating that, as we'll talk about, is purely quantitative and not really subject to analyst evaluation. But now we also have an analyst rating on all the funds that we have under coverage. In addition to that, we have an analyst access and manager research services offerings for folks that work for investment platforms, manager research teams, RIAs, institutional investors, where they can call our analysts and ask them, questions about the various funds that we have under coverage, as well as our broader level research that we're doing. We're greater collaboration with Morningstar's investment management side, where I used to be. And then 2 final things, we're doing much more in work on strategy level research and separate accounts. Those are things that are kind of coming up in the next couple of years. You'll see us expanding into those areas. And then finally, as I've mentioned already a couple of times, increase focus on thought leadership. So all that is entailed in kind of this move from Morningstar Fund Research to Morningstar Manager Research. So that's kind of an overview of team and what we do. Here in the U.S., we cover about 1,000 funds, open-end funds, a smattering of closed-end funds, probably 50, 60, and 300 plus ETFs is our coverage universe here in the U.S. All right, well, let's talk for a few minutes about the Morningstar rating, the star rating, what you need to know about the star rating. This will probably be more than really you need to know about the star rating by the time I'm done, but I think it's important, like I said earlier, to to kind of remind folks about what we're doing with the star rating, what it is, what it isn't, kind of what to look out for when you're using a star rating, or when maybe a client's coming in and waving around a fund saying, this is the fund I either want in my portfolio because it's got a lot of stars, or it's a fund that I don't want in my portfolio because it doesn't have a lot of stars. Really, just very simply, it's just a measure that in a very concise way lets you look at a fund's past performance, risk adjusted and relative to its peer group. I mean, that's it in a nutshell. We also have a cost adjustment that we put on funds. That's just the room, right? That's not me. Sorry about that. The star rating is purely quantitative in nature. I don't hand out stars. My team doesn't hand out stars. It's all it's purely a quantitative risk-adjusted measure relative to category. Every share class of every fund that has at least a 3-year record has a star rating. Star ratings are distributed on a normal curve, so it is not equally weighted quintiles. So it is a relatively rare occurrence for a fund to have a 5-star rating or a 1-star rating. And 80% are 2, 3, or 4 stars. So it's normally distributed. And the star rating combines your short and long-term record. Pardon? It's trying to keep everybody awake. It's early. I don't know. We have... We'll have them check on that. Anyway, the star rating combines 3, 5, and 10-year records, all in one kind of calculation. So the idea really, as I said before, was to call all in one rating to kind of encompass a fund's trailing risk-adjusted record that's between 3 and 10 years. So a couple of things to keep in mind about this. Once a fund hits its 3-year record, or 3-year mark, its star rating is 100% based on that 3 years. Once it hits its 5-year anniversary, 60% of the overall star rating is based on the 5-year trailing return, risk-adjusted, and 40% based on the 3-year. Then, as you can see, once it hits 10 years, then half of the star rating is based on the 10-year record, 30% on the 5-year record, and 20% on the 3-year record. So it's a way of combining sort of taking into account the entire 10 years, weighting it a little bit actually more on the more recent periods. Star rating is relative to a Morningstar category, so that's important to note. Each fund in our database is placed into, in the U.S., one of more than 100 fund categories. They're mutually exclusive, rules-based categories, and they're based on the actual holdings in the portfolios of the funds in the database. So what we do is we calculate the average portfolio statistics going back 3 years on a trailing 3-year basis, and use that information to categorize funds. So we don't categorize funds based on what they say they do, or what the prospectus sort of tries to describe. We don't categorize them based on what's in a name. It's all based on holdings and a 3-year assessment of the holdings. That's reviewed every 6 months to update the holdings, and so it is possible on at any 6-month juncture that a fund's category could change. Now, our objective with the categorization system is not to have funds jumping back and forth and making frequent category changes. So That's not the idea here. But funds can change categories, particularly in areas like the style box categories, the U.S. equity, when some fairly slight style shifts over time someone could find themselves in another part of the style box and eventually shift categories. But like I say, it's based on what's in the holdings and our assessment of the holdings is not based on what managers think. I just had a manager email me yesterday saying, I just noticed my fund's in the large cap growth category. It should be large blend. Here's what, he gave me the prospectus description of the fund and said, and besides that, we don't have that much in technology, we don't have that much in consumer discretionary, but you look at the actual holdings of the fund and something like 63% mapped into large cap growth, and the bulk of the fund is in that style box, so that's what category it's in. So star ratings are based on the category based on the 3-year trailing holdings of the fund. So a couple of things to keep in mind about the star rating, then we'll get on to the analyst rating. One thing is the age of the fund. The ratings of younger funds tend to change more rapidly than those of older funds. So on the one hand, it's a great way, using the star rating is a great way to kind of find up and coming funds out there. But if you've got a 3-year fund that's just gotten its first star rating, it's 5 stars, beware, because the star rating's calculated every month, and the 3-year trailing period for that fund could look quite different in just 1 month as you drop one of the 1 month off the back end and add a new month onto the front end. And so it may not be 5-star for very long. This graph shows that within the U.S. equity asset class funds, I looked at funds that had just reached their 3-year mark and got their first star rating last year at this time, last year in April. And this year in April, only 23% of them had the same star rating. So your star rating is not that stable initially. The longer, the older the fund is, the less likely your star rating is to change from month to month. The other thing to keep in mind is that the star rating is also load adjusted. So if you're using A-share funds, those funds get penalized for the A-share. And so what we've done for a long time now is we also publish a star rating for a load-waived version of those portfolios. And so it's useful to look at that as well, because when you do, you'll find in a lot of cases the star rating of the load-waived fund is higher. That's what this graph shows. In fact, I was looking at all the balanced funds for something I was doing just the other day, and almost all of the load-waived share classes have star ratings above, at least 1 star above the A-share. So just keep that in mind. I think it's useful to keep in mind if you're using A-share funds, because we're trying to recognize that not everybody pays the full load on an A-share fund. And then the other thing is you got to pay attention to the category fit of a fund, and this is one of the reasons why the star rating is a good starting point, for maybe assessing a fund, but not the end point. Here, for example, currently, if you look at the large blend universe in the U.S., the 1-star funds, on average, are those that happen to have more than 10% of their portfolio in non-U.S. stocks. And 5-star funds, by contrast, only have about 3%. So over the last 5 years, it shows over in the corner, the U.S. Large caps have far outperformed non-U.S. large caps, so that's a problem. So it may be that you could have explanations like that are responsible for a certain kind of star rating, rather than just, the manager's not executing a strategy very well. So that's a good thing to keep in mind as well. Just one other example, this is a traditional balanced category. All the funds in this category, going back to the way we categorize things, you have to have at least 40% in equities, but no more than 60%. Right now in the moderate allocation category, the 5-star funds have actually a little more than that 62, 63% in equity. The one-star funds have only about 50, 52% in equity. So that's just, it's kind of a structural disadvantage that they have right now because of the way the markets have behaved over the last 5 years or so that's affecting their star ratings. So you got to keep that in mind when you're evaluating a fund based on a star rating. So just to summarize, age of fund, the load adjustment, the category fit, keep that in mind. Keep in mind, too, the star ratings recalculated monthly, so theoretically it could change at the end of each month. Manager changes are not reflected in the star rating. So the star rating is not just does not reflect the current management team. It reflects that fund over the prior 3, 5, 10 years. And then, as I say, kind of in an overall sense, you got to pay some attention to how the markets have fared over the time period that's covered by the star rating. I mean, it's currently the financial crisis is not any fund that's not yet 10 years old. The financial crisis is not captured in its star rating. It was for a while, now it's not. So you got to keep that kind of stuff in mind as well. So probably more than you need to know about the star rating, but there it is. Any questions about the star rating?
You talked about
Yes.
A share. How about C shares? How does that affect the star rating? Because they have higher expenses. Does it knock it down compared to the A share?
Yeah, well, there's no load adjustment. So that would just be in the expense ratio, and it would be reflected in their performance.
Okay.
Yeah, so.
So you'd expect that C share to underperform when it starts compared to like an institutional.
Yeah, yeah. Yep, over here.
Well, that was kind of my question. We have a fund that has 3 different classes. How do you
Well, so they could. So the question is, if you have multiple share classes, kind of what is going on with the star rating there? Can they vary? And yes, the answer is yes, they can definitely vary. The A share load waves can vary. The C share can vary because different expenses result in different performance patterns. So, one thing that can happen though, it sort of depends where it is in the distribution. If it's kind of in the middle distribution, then it's fairly likely that all of the share classes will be 3 stars. But yeah, if you're pretty good performing fund, you could have maybe a couple of 4-star share classes and a 5-star for the cheapest, best performing or the institutional class. Yes.
A little more color to the third bullet point. Manager changes specifically.
So the question is a little more detail about manager changes in the star rating. So when a fund has a manager change. Portfolio manager, you're right, yeah. It's not, the star rating is the fund's performance. So we've had a lot of questions over the years, and we've actually considered this a lot over the years, whether we should, when there's a significant manager change, should, the star rating just sort of restart from there because, current investors aren't really interested in, past history when a manager is no longer there. But we've not done that, so the star rating is the fund's history, and you just have to keep in mind, okay, it's one thing to ask yourself, is the star rating reflecting the current management team and their record, or how much of the star rating is the current management team responsible for?
And then one other question. So you said that the star rating is based on underlying holdings, so that's as you do for like equity funds.
Mm-hmm.
But what about liquid alternatives that are allocated to actual hedge fund managers? How are you guys analyzing those holdings to be able to say you're in this category or you're in this category?
Yeah, well, so the question was, what are we doing with the alts, basically with the category, can you do holdings-based assessment with alternatives? So the main idea with our category system is that, yes, we try to do that as much as we can, and in some of these more esoteric categories with that use derivatives and so forth, we still have sort of rules-based criteria for the category, even if it's not fully reflected in the holdings. Yes?
To piggyback off what you were saying, so I guess the question is, when you have maybe a disagreement between what you're seeing and what the manager is claiming to be doing,
Yes.
Is there any sort of qualitative assessment to say, okay, you're probably right, our assumption is not accurate?
Yeah, so what do we do when there's discrepancies and the manager wants to make a claim different than ours? So yes, the manager research team does oversee that process. So we're perfectly happy to talk to managers about those kinds of issues. And there are absolutely times when we've said, yeah, that's right. I mean, our category system is trying to categorize thousands and thousands of funds. And so, yeah, anytime there's somebody wants to discuss a categorization and they have a good argument to make, we'll definitely consider that. Yeah. Yes.
What about target date funds? Are they not an exception to the rule based on holdings categorization? I mean, would you put a manager's 2020 fund in a 2040 category if their equity allocation matched the peer group?
That's a good question. No, we wouldn't do that. So target date is the question was target dates, and don't you just go by the name basically or the approach, and that's basically yes how we do target dates.
To match the methodology for other funds?
Pardon?
Any thought to match the methodology for other funds and not just categorize them by name? Would you consider categorizing target date funds by portfolio or asset allocation and not just by the
yeah, the question is whether we should go beyond what we're currently doing with target date funds, and I think as they evolve, there's a possibility. We do have some issues with target date funds in terms of like what should the increments be for the categories, because we can't really make overly narrow categories where, frankly, the star rating calculation wouldn't make any sense. So, with target dates or with any of these sort of newer, rapidly evolving categories, we have to, we're always watching and kind of considering what we could do to improve it. And we would like to, for all of our categories, have them based on holdings rather than other criteria. So that's probably not a great answer, but that's how we do it, yeah. Yes, sir?
Do you ever make exceptions to that 3-year minimum track record in establishing a star rating?
No. No, there are times when, I guess, no. All right, anything else on the star rating? Yes, ma'am.
When you mentioned the rating based off results, risk and cost, is risk just standard deviation? How are you measuring risk?
So the risk assessment is a little more complicated than that. It's really measuring downside risk more heavily than upside risk. It's fairly complicated. I have something I can send people that gives you the whole explanation of it if interested, so let me know afterwards. I had it in the presentation. It was like taking 10 minutes to even get through the first slide of it, but yes?
Slides or materials available? A lot to write down, right?
Yeah, I think so, yeah.
Check at the desk.
Yeah, check at the desk and see. There should be, and if it's not already available through the app, I think we have a way to where you can email the presentations to yourself somehow through registration. We'll figure that out and maybe say something at the beginning of the next session. Yes?
ETFs, what do you do differently, or do you do anything differently?
We are not doing ETF ratings yet. So we have an evaluation process that we use for ETFs that, I think on the just sort of the analysis side gives, our view of the ETF, but we are not rating them yet. We do intend to start rating them. Oh, I'm sorry. I was skipping ahead to analyst ratings. ETFs are rated the same way. Yes, the ETFs have star ratings. All right, well, if more questions occur to you on the star rating, we can certainly come back to that. Let's, oh yeah, I forgot that I had a couple of things about this. Everybody's asking, how does a star rating, how well does it really work? There's been a lot of kind of light research on that over the years. There hasn't been a lot of, I think, real thorough research that has gone much beyond this. But to me, the best thing, or the best way to think about the star rating is that it tends to result in, highly rated funds tend to live long and prosper. So it's kind of a Star Trek thing. And so before you think I'm not a big Star Trek nerd, but I gave this talk on the day that Leonard Nimoy died in the spring, and it kind of occurred to me then. But I think it's a good way to think about it, that highly rated funds tend to live long and prosper. And what I mean by that is that if you look at I looked at the 5-year survival rate even through the financial crisis of funds. If you had a 5-star rating at the beginning of that, 90% of those funds survived the next 5 years. Only about half, just under half of 1-star rated funds survived. And then the other thing, I see in our translation here to the big screen, the circle didn't work. It's supposed to be circling the 5 stars. But another kind of interesting thing that I looked at was, I went back 10 years, and that middle column is just the normal distribution of stars. So, 2005, May 2005, you had that distribution of star rating. I took then those 5-star rated funds, that 10%, and asked, well, what is their star rating today? And so that's 10 years later. This more recent 10 years has nothing to do with that previous 10 years. And what I found was that only 13% of 5-star rated funds 10 years ago are still 5-star rated, but fully half have 4 or 5 stars 10 years later. And something like 80%, 81% have 3, 4, or 5-star funds 10 years later. So they're still pretty good funds. So there is that kind of a persistence there. We're not saying and it doesn't make any sense, right, to say, knowing what the star rating is, it doesn't make any sense to say, this is going to predict the future because it's based on your past performance. But nonetheless, a lot of these funds that have been able to perform well in the past continue to be able to perform pretty well on into the future. Yes, sir.
Intuitively, it seems to me that one characteristic of a 5-star fund that continues that way would be the lower the expense ratio, the more likely to stick around. Is that correct?
Yeah, so the question is, what's really is how is this related to expense ratio? And it's related to expense ratio for sure. The 5-star funds, in fact, if we would have done that, and my colleague Russ Kennel's done some work on that in the past, and yes, expenses, really low expenses are more predictive, really, than the star rating.
I say they're more predictive than anything else, is that right?
Yes. All right, so that's the star rating. There are issues with the star rating in terms of, it's a great way to start out maybe research, great way to call the universe for just the funds that you want to pay some attention to. But it's not a be-all and end-all. It doesn't really say anything about the future other than the fact that, well, okay, that fund's going to be around, and if it's low expenses, it's probably going to be a decent fund. So one of the things that we've instituted that's now we're about 3 years in on this is the Morningstar Analyst Rating for funds. And it's actually quite different because it's based only on the funds that we cover. So like I said earlier, we cover about 1,000 funds in this manner, the analysts using their framework for analysis. And we've developed a rating that's forward-looking and based on that in-depth work that the analysts do. It's also a collaborative process, so it's not just sort of one analyst out there saying, here's, I've done the research by myself and here's my own opinion on the fund. It's a collaborative process that our entire team participates in. And the result of it is that we award what we call medals for funds that we believe, looking forward, have a chance to outperform their category or benchmark on a risk-adjusted basis, over the coming market cycle. That's really our criteria. It's based on our assessment. We're able to award medals to those kinds of funds. The difference between, we have gold, silver, bronze. The difference between a bronze medalist fund and a silver or gold is the overall level of conviction that our team has in that fund's ability to outperform in the coming years. We also rate funds neutral and negative if we feel like neutral is obviously, as it implies, a fund that we don't really have a strong view one way or another on its ability to outperform, and negatively rated funds are those that we think really have structural defects that will keep it from outperforming, and we wouldn't recommend. So we now have this analyst rating in play and live on all of our funds that we cover. And it's in the next session, the next hour, we'll delve into this a little further, but it's all based on our framework for analysis. What we did was 20 years of fund research. We really sat down and said, how is it that we, if we wanted to really systematize the way we cover funds, what would that look like? What would a system like that look like? And this is what it is. We call it our 5 pillars framework. We go into, for each fund, we look at the people running the fund, the process, the parent company, the performance of the fund, and the price of the fund, and put all those together to overall evaluate the fund and come up with a rating. Again, more to come on this. The way the rating system works is the analyst covers the fund in the context of asset class teams. When the analyst is ready to bring the fund forward for a rating, a ratings note is prepared, and it goes to a ratings committee, and the analyst has to defend his or her recommendation to the ratings committee, and once a rating is approved, then the analyst writes the global fund report that evaluates the fund and provides the rationale for the rating. A rating is in effect for 12 months, so it's a year long. It's going to be in effect for a year. The analysts at the end of 12 months will re-evaluate the fund. Anytime there's a material change that happens with a fund during that 12-month period, the fund gets put under review and is re-rated, within the 12-month period. And there's just a picture of our global fund report. So a couple of things this all implies. Well, what's the relationship between the analyst rating and the star rating? Well, in the analyst rating, performance is one of the 5 pillars that we evaluate, but we're really, we're assessing past performance, but we're also, trying to understand what the likelihood of outperformance is going forward. So a fund could have a relatively low star rating, but a high analyst rating, for sure. That could happen. In this particular case, this was a fund that, when you go into our report, you really can see that it's the process that we think is very important here, and that it's going to outperform in the future. It has in the past. It just had hit kind of a little blip in terms of its performance in the recent past that had caused its star rating to suffer, but it didn't. It was one of those strategies that we felt in all these other respects was a superior strategy, so it got a gold rating. Then by contrast, there's sometimes these kinds of situations where a fund that's got a very high star rating, something's happened with the fund that's not yet reflected in its trailing returns. But with an analyst rating, you can put the fund under review and immediately assess that and put that and build that into the rating. So in this case, this was a fund that had some very major manager changes, and then additional changes to the management team, and then significant outflows. And I think when it was first rated negative, it was actually a 5-star fund, and it's now started to maybe trend down on the star rating front. But you know, it'll be a useful thing for us to for users to be able to use the analyst rating there to you know, definitely discount the star rating. So they don't have to agree. And in fact, you know, our analysts, when they're developing their rating of a fund, really the star rating doesn't really even come into play, other than it helps us understand what the past risk-adjusted relative performance is. So we'll go into some more detail about that. We're going to have analysts in the next hour to really talk about like how we evaluate funds, give some examples, and go into quite a bit more detail on the analyst ratings. The final thing I wanted to just mention, and again, this will be brought up again in the next session, and we also have a session at the conference on stewardship, but I think it's important to mention, at least in this context, that we give asset management firms grades or parent evaluations as part of our analyst rating. So the parent receives a positive, neutral, or negative rating. For the largest funds, like the largest 20 asset management firms by AUM, we issue much more in-depth stewardship reports, approximately every 1 to 2 years, about every 18 months, that evaluates the firm. And we're interested in 4 things. We're interested in the corporate culture of the firm and kind of getting a sense of that, and we're really interested in, you know, is it a stewardship culture, is it a salesmanship culture? You know, how well aligned with shareholder interests is this firm's culture? That's really what we're trying to get at with the parent ratings. We're also interested in managers, how managers are incentivized. Very interested in whether managers are actually investing in the funds that they run. We're interested in fees in an overall sense. You know, is this a firm that typically charges a lot of high fees, you know, doesn't use break points, or is it one that has, you know, more shareholder-friendly fee structures across the board? We're interested in a firm's regulatory history. You know, has it followed the rules or had major slip-ups? And we're also interested, especially in our stewardship grades, in the fund's board. You know, is it a board that's actually aligned with shareholder interests and looking out for shareholder interests, or is it just kind of an arm of management? So we look for all those things, and as we assess the parent firm of all the funds we cover. So every analyst-rated fund out there has got a parent rating embedded in it as well. And as I say, we do stewardship ratings, the stewardship grades for the largest funds. And just a couple of things, sort of outcomes to this that we've seen. One is that, you know, the firms that we have rated positive, so rate firms positive, neutral, or negative, their success ratio, that's basically the live long and prosper idea, the success ratio of the positive rated firms is higher than those that are rated neutral or negative. And we see that in a pretty persistent way. So we think it's important. The other thing, and this is, I'm sorry we didn't do a better job on this particular slide, but when manager incentives, now I don't know if you know this, but the SEC requires funds to say how much their managers are invested in the fund, and it's kind of a crude measure, you know, from zero to 100,000 up to, I think the highest level is $1 million plus. But anyway, it's data out there that, you know, the SEC requires and that we can look at. And, you know, what we found is that, generally speaking, funds that have managers that have a significant amount of money invested in their strategy, they tend to have higher success ratios as well. So a couple of examples of why we think our stewardship is important and why our parent grades are important to an assessment of a fund. Just back to the analyst ratings for a second. This is the distribution of our analyst ratings that are currently live. You know, it's definitely skewed towards having medalists, but that's partly a reflection of our coverage list. You know, we're generally not that interested in covering a lot of and spending a lot of time on funds that we don't think are any good, right? So you get a neutral rating or a negative rating, and you may not be even in the coverage list for very long. However, just keep in mind overall, the gold medal, the gold, silver, and bronze is listed on the previous slide, that they are only at 9.2% of the overall fund universe. Question? Yes?
So, if a fund drops off the coverage list, is there a final report saying we're dropping this fund?
Yeah.
Or is it just not done?
Yeah, you know, we are in the process of improving the way that we do that, because in the past our coverage list had really been you know, it was just, we didn't change it. It wasn't as dynamic as it is today. So typically, I mean, we would so there would be times when something just gets, you know, dropped off the coverage list and there's no comment. So that is still to come, but we're going to be, you know, doing that. And my general thought is that anything that's neutral or negative, it probably should, we look at it one more time, you know, and if it's still neutral negative, then that's the point at which it could get dropped. Our asset class teams currently, what they do with their part of the coverage list is that they have kind of they're keeping kind of a list of like funds that are on the bubble, you know, for potentially cutting them from coverage, and then prospective funds that we would like to be covering because we think they have promise to add. So the coverage list is fairly dynamic going forward. Yes, sir.
Will there be any discussion of what criteria Morningstar uses to rate a fund? Because, you know, most of the time I look at it, I say it's not rated. That's not a criticism, but what does it take for Morningstar to rate a fund?
To cover a fund in the first place? Yeah. What does it take for us to cover in the first place? Well, you know, we can't cover them all, right? So, you know, generally we have this, the idea is that we want to cover the funds that we think are the most relevant to investors. So on the one hand, it's got to be a fund that's got the interest shown by AUM, right? But we also are always on the lookout for funds that we just think are good investments, good for investors. So it's not a, you know, hard and fast formula. It's just, you know, when
size important criteria?
Size has always been a fairly important criteria. Yes. It's becoming maybe somewhat less important now as you've got a lot of big funds out there that really aren't necessarily gaining many, you know, assets. We're increasingly looking more at flows. So certainly funds that investors are showing interest in by you know, putting flows in are going to be funds that have a better chance to be in our coverage list. Yes, 3 years ago, and I mean we had a first wave in kind of 3 years ago, December, and another by about this time 3 years ago we had 700 or 800, I think, rated by then.
Shows how those initial gold medal winners have fared over 3 years since you were predicting how they would do.
So we've certainly been looking at the results. Oh, sorry. I'm sorry. Yes. The question is, you know, they're 3 years old now. Do you have any kind of how have they fared? How have your gold medalists fared thus far? And I have, you know, as I say, we've certainly been looking at the results. One of the things that we're a little bit hesitant to make any conclusions early on because 3 years is really not the idea. When we first put together the rating system, the idea was kind of a 5-year holding period or a kind of full market cycle. And I know that sounds like, well, everybody talks about 3 years trailing, you know, performance when they evaluate funds, but we really felt like that was an important distinction to make. with the analyst ratings, that we weren't looking at just the next 3 years. We wanted to encourage longer-term holdings. So thus far, what we're seeing is a pretty good ordering of results. You know, gold's generally doing better than silvers and bronzes, but all three are doing, you know, what we think of as pretty well. I've got one slide here that I'll show you that is not quite what the question you asked is, but it's here is how gold medalists have fared. But what we've done here is going back all the way to 2002, we had been identifying our top picks in each category, and those picks became, in many cases, our first gold medal funds. So we did go back and look at we have gone back and looked at their long-term records, and that's shown in this slide here. So so the gold funds, you know, that's not gold funds that have, you know, this is not gold funds since our rating started, but the gold funds that we have had as analyst picks going back for 10 years and how they've fared over time. Certainly at the 5-year mark, we will be, you know, producing our results and taking a look at them for sure. Yes? So that was success ratio was the live long and prosper. So it was the percentage that survived and outperformed their peer group.
So just being in the top half?
Yeah, yeah.
Over what periods?
Well, whatever period that, you know, 3, 5, 10. I can't remember if the slide had, yeah, 3, 5, and 10.
Taking into account survivorship?
Yeah, yeah, yeah. What other questions do we have? Yeah.
Conducting a study to see how long a certain fund will hold its, let's say, star rating or even its analyst rating?
I don't know about the star rating. One of the things the Global Fund Report does is it shows you over time the up and down of the star rating. So the question, and as far as analyst ratings are concerned, you know, we haven't looked at that thoroughly yet, but you know, analyst rating could only change a couple of times since we've only done it for 3 years. And you know, in our ratings committees, you know, we're not necessarily wanting to, you know, bounce back and forth necessarily. It should be that should be fairly consistent over time. Yes?
Can you speak a little bit to analyst compensation? Are they tied to the star ratings or the medalists?
So analyst compensation tied to any of the ratings, well, definitely not to the star ratings, right? Because analysts don't have anything to do with the star rating. It's purely quantitative. Currently, no for the analyst ratings either, but it's something that is being contemplated. Yes?
Within the pillars that you're talking about for analyst ratings, so do you weight, for instance, one coming more than the other?
Yeah, so the question is with you have the 5 pillars, how are they weighted in the ultimate overall rating? I'll let the folks get into that in more detail in the next hour, but yeah, there is some, they're not all just equal weighted. There's some underlying scoring that takes place that that points you towards the logical rating, but it's the ultimate decision is based on the analyst's recommendation and the ratings committee's decision. All right. I'm going to, we have about 5 minutes till 11. I think what we're going to do is let's take a quick break and let the analysts come up on stage before we start the second session. There are restrooms just to the left. And any other questions, just let me know. I'm around the entire conference, so feel free to stop me. I'd love to be able to chat with you individually. Thank you.